Hey guys, Blair Applegate with Pacific Coast Wealth Management coming to you live from the Bank of New York Mellon ETF conference held every year right here at the St. Regis Monarch Beach Resort in Dana Point, California. It's a great convention that we attend every year. All the big ETF issuers like BlackRock and iShares and PowerShares and Guggenheim and Van Eck, they're all here, and great opportunity to actually meet the portfolio managers and ask questions. And what I want to talk with you about today is the difference between the tide and the surf. We're right here, less than a mile from the Pacific Ocean. A great destination. I do encourage you to come out and check it out. I'll show you all around. So what we've seen is that basically since the end of 2014, beginning of 2015, we reached high tide in the U.S. economy. We had about 3% GDP growth. Since then, we've seen GDP growth trend from 3% to 2% to 1% to this year in 2016, a couple quarters with 0.5% growth or so. And so what we know from that is that the tide is basically going out right now in the economy. And that happens. Economies go through business cycles, right? The tide comes in, the tide goes out, and that happens. So all you have to do is make sure that you're invested accordingly, that your portfolio is allocated accordingly. And that's what's already been done for you if you're a client of Pacific Coast Wealth Management. The important thing to understand is the difference between the tide that comes in and out and the surf that goes up and down and creates a lot of volatility. Most of that actually created by people that don't surf, people that don't manage assets, people that don't run money in the real markets. People like Ben Bernanke and Janet Yellen and the Federal Reserve, right? They just get on the microphone, they talk, and they create a lot of surf. They create a lot of volatility. And they've been doing that really for the last year, ever since they raised rates in December, and stock markets around the world sold off. There was all kind of volatility. People were getting dunked, right, in the surf. And everyone was freaking out. So the Fed came out and said, hey, okay, we're not going to raise rates anymore. And the waters calmed a little bit. And then they said, oh, it seems like the waters have calmed. Maybe we can raise rates again. And here came the surf again, right? And then they came out again in like May. Oh, we're not going to raise rates right now. And then the Brexit happened. And then they said, okay, for sure, we're not raising rates. And then after the waters subsided and people thought, oh, Brexit's not the end of the world. We can raise rates after all, right? And so here we are, we're in September. And they still haven't raised rates, even though they said 5 times they're going to do it this year, 5. So basically what that tells me is that they don't know how to forecast anything. If you want a good surf forecast, go to surfline.com. Those guys are so good, they'll put you on the front end of a 30-foot surf swell anywhere in the world, Africa, Tahiti, Hawaii, Greenland or Ireland, you name it. Surfline.com is good forecasting, not the Fed. And the important thing for our clients to understand is that our portfolios are positioned for the tide and which way the tide goes, not what is happening in the surf on a month-to-month basis, especially when that surf, that volatility, is just created by a bunch of central bankers that actually aren't in the market. Many of them never actually even worked in the live markets. So just understand that there's a difference between the surf and volatility that the Fed is creating and the real tide of the economy. We've reached high tide. Tide has been ebbing out, and our clients own assets that are going to function with a smooth ride in that environment. And if you look at it, this year is a great example, right? If you own high-quality municipals or treasury bonds, you're up almost double digits, especially if you throw in a little bit of gold, right? But every time the market thinks the Fed's going to raise rates, those assets sell off a little bit. And actually, it's just a great buying opportunity. That's been the case 6 times so far this year. Every time the Fed says they're going to do something, if you just bought a little bit, that was a great buying opportunity. And so, personally, don't think tomorrow is really any different. If they do raise rates, it's an even better buying opportunity. Because at the end of the day, they can create surf, but you have to be invested according to the tide. That's how you manage risk in a portfolio. That's how our clients are set up. And if you have any questions about that, give me a call, send me an email. I'd love to talk with you. Thanks very much and have a great day.